In this lesson, we're going to look at a progressive tax system versus a flat tax system. So an important thing to note about the tax code is that it is the result of political forces, not economic forces, so it doesn't necessarily have to make economic sense. And this is the case for tax codes for most countries. We're going to start by looking at a progressive tax system, which until recently was the type of tax system that the US had for corporate income taxes. The personal income tax system is still a progressive tax system, so it's still important to talk about this. And many other countries around the world also have progressive tax systems. A progressive tax system is a tiered tax system. That means that we have different income brackets, and those different income brackets have different tax rates. So this may actually make more sense when we look at a progressive tax system table. But what this type of system does is that individuals with higher taxable incomes end up paying higher tax rates, whereas individuals with lower taxable incomes end up paying lower tax rates. A flat tax system, on the other hand, means that all taxpayers are charged the same tax rate. Currently, the corporate income tax system in the United States is a flat tax system, and corporations are charged a flat tax rate of 21% on taxable income. This is what a progressive tax system looks like. So we've got taxable income brackets, and then we've got the tax rates that we apply to those different brackets. Here's how this works. Everyone's first $50,000 of income gets taxed at 15%. Let's suppose you made $25,000 of taxable income this year. All $25,000 would be taxed at 15%, because it's all still in this first income bracket. Let's suppose instead that you made $120,000 of taxable income this year. The first $50,000 of that $120,000 would still be taxed at 15%. But because you made more than $50,000, we would then move into the next tax bracket, and your next $25,000, which comes from the top of the bracket, $75,000, minus the bottom of the bracket minus 1, so $75,000 minus $50,000, that comes to $25,000, and we tax that at 25%. Now the reason we have to go back to $50,000 is in order to count that $1. If we look back here at the first row, we said our first $50,000 are taxed at 15%. That's $50,000 minus 0, not $50,000 minus 1. In order to count that $1, we need to go back to the 0. So back to the second income tax bracket, our next $25,000 would be taxed at this 25%. Because we made $120,000, we need to move into the next income tax bracket. We made more than $75,000. So here, our next $25,000 of income, so $100,000, which is the top of the bracket, minus the bottom of the bracket minus 1, so $100,000 minus $75,000 gives us $25,000, and that gets taxed at 34%. We made more than $100,000, so we move into the next tax bracket. Now in this tax bracket, we don't tax the whole bracket because we only made $120,000. So we tax $120,000 minus $100,000. So that's just $20,000, and that gets taxed at 39%. Now that we know what we owe in each tax bracket, we would add all of those amounts, and that would be our tax bill or our tax liability. Obviously, if we made more than $335,000 in taxable income, we would continue into the other tax brackets. Let's try an example. Suppose your firm earns $140,000 in taxable income. What is your tax liability? If we're assuming that we're in a progressive tax system, like it tells us at the top, we're going to need our progressive tax table. So this is the same table from the previous slide. And because the calculations can get a bit tedious and we can get a bit carried away, it's always a good idea to draw a line underneath the tax bracket that you're in. Since we earned $140,000 in taxable income, we're going to draw a line underneath the fourth tax bracket because that's where we find $140,000. Now let's get started calculating our tax liability. We'll start in the first bracket, and we know that our first $50,000, so $50,000 minus 0, gets taxed at 15%. Notice that we converted the percentage to a decimal. Always convert percentages to decimal when you're using them for calculation. So $50,000 times 0.15 gives us $7,500. Since we made more than $50,000, we move into the next tax bracket, and we have $75,000 minus $50,000, so that gives us $25,000 times our 25%, or 0.25, and that gives us a tax liability in this bracket of $6,250. Then we move into the third tax bracket because we made more than $75,000. So the top of the bracket, $100,000, minus the bottom of the bracket minus 1, so minus $75,000, times our 34%, which we converted to a decimal, 0.34. That gives us $25,000 times 0.34, which is $8,500. Now we move into the last tax bracket. And the fact that we drew the line here reminds us to go back to our taxable income, which is $140,000, and that's where we're going to tax up to. So we've got $140,000 minus the bottom of the bracket minus 1, so minus $100,000, times 39% or 0.39. So that gives us $40,000 times 0.39, which is $15,600. Now that we know what we owe in each bracket, we can add those amounts up, and then that would be our total tax liability or our total tax bill, and that comes to $37,850. Let's try the same example, but now in a flat tax system. Suppose your firm earns $140,000 in taxable income, and the current flat tax is 21%. What is your tax liability? This is much easier because the tax rate is flat at 21%, so you don't need a tax table. It's just $140,000 times the 21%. Of course, we'll convert to a decimal first, so $140,000 times 0.21, and that's going to give us a tax liability of $29,400. So this is our tax bill. This is what we owe in taxes. So with a flat tax of 21%, we owe $29,400 in taxes. In the progressive tax system, using these income tax brackets with these particular tax rates, our tax liability comes to $37,850.